Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 153. And there's lots going on in the world. But before we get on into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Let's go for this week, Keith.
Thank you, Richard. Before we get going, some housekeeping. We are having a live Discord Q&A with Rogue Trader on Tuesday at 7:30. If you're a member of the Discord, please join us. In addition, I'm afraid there will be no PM next week either, as I'm going to Boston to run the marathon. But after that, we will be back for a decent run of weeks. So, news this week. Well, Jerome Powell gave two speeches in which he stated that the strengthening US economy meant that he was in no hurry to cut rates. Bond yields rose. BYD and Tesla, which are both big electric car makers, reported that their deliveries fell in Q1. And it seems that the electric vehicle revolution has very much stalled. EU inflation for March came in soft at 2.4% versus 2.6% expected, and that's great news in the EU. And the ECB seems very much on track to cut rates in June. Gold reached an all-time high, and then last night, oil surged above $90 a barrel on the back of increased tensions in the Middle East, particularly the UAE, United Arab Emirates, cutting ties with Israel. And there was a late sell-off on Wall Street with the NASDAQ down 1.4%. Now it is up in the futures market this morning. So it's not clear whether that is a sign of the start of a correction or not. Some charts relating to the news. Well, this is the NASDAQ, late sell-off, but frankly, it's only down 2% from its peak. It's nothing. Noise. We will see whether it is a harbinger of start of a correction. This is Brent. Now, lots of things going on in the oil market. So, tensions in the Middle East. This week, OPEC Plus reaffirmed its cuts, and also NATO released an assessment that Ukrainian drone attacks on Russian refineries had taken as much as 15% of Russian refining capacity out of the market. All that leads to a tightening oil market and rising oil prices. Gold also had an excellent week, up the best part of 5% over the last 2 weeks since we last reported, and it was above $2,300 an ounce within the week. Turning to the Fed, well, the markets are increasingly concerned that strong US economic data will lead to the Fed not cutting as much or as soon as they'd previously anticipated. And they're now not even sure that the Fed will begin cutting in July. But Jerome Powell has restated he expects to cut 3 times this year. The white line here is US GDP growth. The blue line is the Fed funds rate. And the US economy has been astonishingly resilient to the rise in interest rates. Will that continue? And this is the latest interest rate probabilities, and you can see that the market is pricing in basically a 90% probability that the Fed will start cutting before September. Moving on to electric vehicles, these are the EV deliveries for Tesla and BYD, and that it's a really sharp drop in Q1. So as subsidies have come off, the EV revolution has come to a very sudden halt. Tesla shares are well down from their peak, but they remain on a forward PE ratio of 54 for a company whose revenues, whose deliveries are declining. And on to this week's economic data. So a quick summary. Little change, UK weak, but showing signs of bottoming. The same for the EU. The US is strong, but there's showing signs that the rate of growth is actually slowing, whereas the market seems to be expecting a cyclical uplift in the US economy. We'll go through the data. There is very little sign of that. In China, it's difficult to tell, but the recent PMIs were better than expected. Weak but improving, question mark. Global manufacturing, however, is definitely showing signs of a cyclical upturn. The UK, Richard.
Thanks, Keith. So Bank of England consumer credit, pretty stable, really, isn't it? At that level.
Yeah, that looks, perfectly in line with history. No problems there.
UK mortgage approvals showing a bit more life, and net mortgage lending is also showing a bit more life, obviously in line with the increasing approvals. I mean, there's all sorts of oddities going on in the housing market. If house prices query falling, but fundamentally there's a shortage of housing in the UK, which is going to put a floor under house prices, I think. UK net lending to individuals, it's a little bit up, but still below its long run trend in the late teens.
Yeah.
And UK M4 money supply, it's not falling, it's plateaued, really.
Yeah, but it's picking up again, actually. And if you're a monetarist and you think that quantity of money is responsible for inflation, then that is a concern.
The UK manufacturing PMI is actually looking moderately healthy now. Actually, if that trend continues, that would be very nice.
Yeah, that is a big tick up from last month into expansion territory. UK manufacturing, in fact, global manufacturing is doing better. Cyclical upturn.
And services PMI, yeah, it's bouncing around, isn't it? But it's fairly level at a modest rate of growth, as it had been all the way through the second decade of the 20s.
Yeah, but it's not strengthening.
No, it's not, is it?
It's two months in a row it's fallen.
Yeah, but it's at the moment it's still relatively stable.
Yeah.
And there's the composite, which is showing a composite growth of the UK economy.
Yeah. Reminder, the PMIs have been showing that the UK economy has been in expansion for a little while now. Actually, Q4, it was down slightly. It actually contracted by, I think, minus 0.3% in Q4.
Yeah.
And the forecasts are that growth in Q1 will be 0.2%. So the PMIs are positive, but it's not clear we're getting much economic growth on the back of them.
Yeah. UK nationwide house prices fell in March, which is a bit of a change of trend there. And house prices, nationwide house prices year on year, no, they're still, you can't say that trend has changed. They're still in quite a strong uptrend. Or rather, the rate of change is in quite a strong uptrend.
Yeah.
And month on month, Halifax survey saying that house prices fell 1%.
Yeah, so Halifax are saying the fall in March was bigger than Nationwide is saying, but they're both consistent in saying that house prices, having had this, 5-month resurgence, fading again.
And the year-on-year house price index from Halifax is just above zero, but the rate of change is declining. Are we actually going into a period of declining house prices, despite what I said a few minutes ago?
Well, I mean, the thing to point out yet again, Richard, is it's an average of the price of houses they've written mortgages on.
Yeah.
So if they're writing mortgages on smaller houses, that will create a bias in the index.
UK car production, it's quite a lumpy little chart, that, isn't it? But it's sort of in the middle of the range, really.
Yeah.
Middle of the recent range.
We got all excited early in the year as production surged, but that has since faded. And reminder that, in the last few years, the explanation for the big decline in UK car production was that factories had closed production lines to retool for the production of electric vehicles. But we've seen from EV and BYD that actually consumers are not convinced by electric vehicles. So I would be slightly concerned that the UK car industry has retooled EVs and the consumers don't want them.
The problem is that they are really quite a lot more expensive, aren't they?
Yeah.
And there is this range anxiety, which I think is legitimate, especially if you don't live, well, just generally speaking. Economics Price Index, we've got this continuing downward trend in Indeed job postings.
Yeah.
We don't know whether that's people not using Indeed. That's the issue, though.
That is true. But in the rest of the world, certainly have seen actually a drift towards more online job postings.
Yeah.
Whether Indeed is itself doing well within that market is the question.
That's right. UK Trueflation, 3%. And they're fairly sharp, well, the very sharp decline all the way from nearly 17% down to 2.8 or whatever it went down to, has stopped.
Yeah.
I would say definitively stopped. And there seems to be quite a lot of price pressure in the pipeline now from commodity prices.
That's true. But reminder that UK inflation has a very strong seasonal component. So a lot of the inflation occurs in the 4 months, February, March, April, May. And so, the fact we've seen this resurgence in trueflation is not unexpected, frankly.
Yeah.
And a lot of inflation will be caused by wages. And
Yeah.
if wage inflation is coming down, then hopefully UK inflation should come down. But you're absolutely right about commodity prices rising. And we take you through the industrial commodities. Industrial commodities generally had a very strong week on the back of rising Chinese manufacturing PMIs.
UK shop price inflation, all categories continuing to fall.
Yeah.
And non-food is pretty much at zero now.
Yeah, that's great. This is really good news for the UK.
Yeah. So we've got a bottoming of mortgage approvals, return to growth for the PMIs. Services are certainly not growing, as we discussed. Inflation, I'm not sure that we would expect inflation to continue to keep falling. I actually think the jury's out on that. I think we have to wait and see now what happens. I'm very mindful of the cyclical nature of inflation. But the UK economy is stagnant, and we do need to get a significant degree of growth if we're going to dig ourselves out of the fiscal hole that the government has got us into.
Yeah. Thing is, Richard, I think inflation will continue to fall. And I think that the inflation is largely a result of inflation expectations and wage demands. And the UK economy is stagnant. I mean, it's growing by 0.2%. Basically, the Bank of England needs to get inflation under control so it can start cutting rates and this economy can start growing again.
Yeah.
And onto the EU. So we had EU inflation numbers for March, and they were better than expected, but still not great. So month on month, they came in at 0.8%, which was below expectation 0.9%, but still up on February, and that is not a good number. Year on year, though, inflation came in at 2.4% below expectations and continues to drift downwards. Core came in at 2.9%, down on February and below expectations. So that is all good news. Producer price inflation also came in below expectations and was minus 1%. So that is really good news. So it shows underlying pricing pressures continue to be weak. And year on year, down an astonishing minus 8.3% on the back of falling energy costs mainly. So all that adds up to low inflationary pressures in the EU and expectations that the ECB will be the first central bank to start cutting rates in June. That's 2 months away. The unemployment rate did not fall. It was expected to fall further to 6.4%, but it stayed at a record low of 6.5%. So the EU economy currently is not doing well, but unemployment remains at record lows. Economic sentiment ticked up in line with expectations to 96.3, still not a great number. Industrial sentiment actually was surprisingly weak, given with the PMIs showing a cyclical upturn in manufacturing. They did improve, but that's still a poor number. Services sentiment also improved, but not as much as expected. Consumer confidence is slowly improving. Consumer one-year inflation expectations fell, and that's good, and that is towards the lower end of the historic range. So EU consumers are not expecting inflation to remain high. Selling price expectations ticked up, but are still low. So the final PMIs, manufacturing came in at 46.1, which was actually worse than February. So in the EU, at least, we're not seeing a cyclical upturn in manufacturing. Services PMI ticked up in line with expectations to 51.5. So that meant the composite was at 50.3, above 50. So according to the PMIs, the Eurozone economy has returned to expansion, weak expansion. But the construction PMI was expected to improve to 45. It actually fell further to 42.4. That is a really bad number. That was out this morning. So the EU construction industry is doing very badly, and it really needs an interest rate cut. Economic Surprise Index remains strong. EU loan growth appears to have bottomed, which is good news and signs of a turnaround in the credit impulse, which should feed through to economic growth. And talking about the construction PMIs, this is French construction activity, and that is really, really bad.
That is awful, Keith.
Yeah. But that I noticed actually that is a few months out of date, but still very poor. So in summary, EU inflation continues to fall and the ECB appears to be on track to start cutting rates in June. Services activity continues to strengthen, and the latest composite PMI shows the overall economy returning to weak growth. Bottom line, the EU economy is weak, but appears to be bottoming. On to the US, Richard.
Thanks, Keith. So JOLTS opening, continuing its downtrend, I would say. A little bit better than expectations.
Yeah, can I come in here, Richard? Because the numbers which show, here, the JOLTS for March is showing as a slight beat on expectations. But, big but, they've revised down the entire historic record, okay, from last month. So it's a beat on revised numbers. And so if you look at what we reported last month, and so this is from the PM last month, you will see that job openings peaked above 12 million. Now, if we show you the numbers they're reporting now, they've revised that down by what, 300,000 or something? Certainly, it's a very substantial number. And so, there seems to be this systematic upward bias in the initial numbers reported for employment and job openings, etc., in the US, and then they're revised down later. Now, frankly, I'm not really going to criticize them for that. If you're going to do an estimate, then surely you want to estimate on the high side first. But the general picture actually is that jobs market is not as strong as had previously been shown.
Yes. Yeah, that's interesting, Keith. So the job quits is also declining. So fewer people leaving their jobs.
Yeah, it did tick up, and it has ticked up in the last couple of months, though.
Yeah, it's sort of getting back down to the pre-COVID norm, isn't it? It's not sort of there yet, but it's heading in that direction.
Yeah.
And the job hiring rate now, which is following just a fairly typical, straightforward downtrend, and it is sort of in the middle now of its pre-COVID norm.
Yeah.
And the layoff rate, pretty difficult to see. I mean, that looks pretty steady, doesn't it? Over a long period of time, excluding COVID.
So what seems to be happening is companies just not hiring and not firing.
Yeah, it looks. I mean, just looks fairly uninteresting, to be honest. It's just heading down, either at or heading towards the pre-COVID norms.
Yeah.
But this is a survey that shows workers are more optimistic than they have been about finding jobs. So interesting that that if you look from January 16 to the end of 2019, there was a significant rise in people's expectation of the ability to find a job.
Yeah, that's true, actually.
And according to a broad range of measures, including the ones we've just looked at, I think the labour market appears to have or to be in the process of normalising.
Yeah, absolutely. It's not getting, it's not heading towards recession, but it's no longer red hot.
Yeah. And as I think I've said many times before, the JOLT survey response is very poor, and so the data can be misleading. And then we show the NFP data there, which is showing a significantly higher response rate, much higher response rate.
Yeah, still not great.
No.
Non-farm payrolls are out later today.
As are last month's revised numbers.
Yes, of course.
The ADP employment change was revised up February and is better than expected in March. So it shows that suggests the employment market jobs market is healthy.
Yeah.
And the job challenger cuts, yes, there's nothing remarkable there at all, I would say.
Well, it has ticked up.
Yeah, but
go on.
Well, I was going to say, I agree, Keith. I mean, if you go back pre-COVID, we haven't got much pre-COVID data. It's higher than that. Post-COVID, it was very low. Yeah. And I think you can understand why that was. But now it seems to have sort of established a new range. And it's sort of towards the top end of that new range, but it's not above it. So,
yeah, I agree.
So the US PCE inflation, PCE, so the PCE inflation month on month is fell from last month, which was quite high, unexpectedly high, but still a bit on the high side here. And last month's was actually revised up from 0.3 to 0.4, which is quite a significant revision. And the PCE inflation year on year, still in that downtrend, I would say. PCE inflation month on month, pretty stable. If you ignore that big peak with the last reading, pretty stable actually over the last 12 months, as in not going above 0.3%. And there it is year on year, still falling. US personal income month on month. I guess the US have a lot of pay rises in January, don't they, Keith?
Yeah.
So US personal spending month on month a sharp increase, and the highest it's been in 12 months, at least 12 months.
Yeah, and far outstripping the increase in income. So
Yeah.
not sustainable.
No, but people obviously feeling confident to go out and spend. US
Yeah.
factory orders month on month, a little bit up. This is it's sort of within just the normal ebb and flow, I would say, isn't it? This how this chart looks at the moment. US factory orders ex transport looking better than really it's looked for the last 5 or 6 months.
Yeah, so further evidence of a cyclical upturn actually in manufacturing.
Yeah. Durable goods orders month on month, quite noisy series of data this, and we sort of, we need to see whether there's a trend going to develop. But at the moment, it's just bounced up from a poor month last month. And durable goods ex transport month on month in positive territory. So again, the economy looking to be growing. Construction, however, down month on month for 2 months in a row.
Yeah, now this is really interesting.
Quite a sharp change from the previous 10 months of data.
Yeah, this is really interesting because the course of the last year we've been, talking about how there's been loads of infrastructure investment in the US and manufacturing infrastructure due to the CHIPS and IRA Act and the fact that housing has been surprisingly strong. But we always expected that to come to an end at some stage.
Yeah.
Now, is that finally happening?
Yeah, because a big decline, isn't it?
Yeah.
We've got a number of readings of 2%, everything's positive, and now suddenly we've gone negative. And we've got construction spending falling for 2 months in a row. Although when you look at it in the context of this chart, you just said it was a bit of noise, isn't it?
Yeah.
So we need to wait to see whether we've got further confirmation of that. So consumer confidence is actually pretty high in respect to historical.
Yeah.
And the global manufacturing PMI is well into positive territory and sort of roughly in the middle, I would say, of the pre-COVID range.
Yeah, but notice, according to the S&P Global, it's not improving. It's expanding, but not improving. But I'll show you the ISM in a minute, and that shows a different picture.
Global services PMI is not looking. It's trudging along. It's not showing any significant signs of wild activity, I would say. And the composite PMI is pretty level and showing a little bit of a positive growth. And there's, as Keith said, there's the ISM manufacturing PMI, which is slightly positive and appears to be moving up. Yeah,
so the S&P have been saying that manufacturing has actually been expanding for a few months now. And the ISM suddenly has turned positive and it appears to be catching up.
Yeah. Manufacturing employment, it's in a downtrend, isn't it? But it's quite a slow, gentle downtrend. And new orders looks like it is now in an uptrend. Interestingly, manufacturing prices paid is in an uptrend from a pretty low point, the 39, but it's in an uptrend. And in March, we had a broad-based rise in ISM, in all the ISM manufacturing components. So that's the light green bars. And the ISM services PMI is oscillating between 50 and 55, really.
Yeah, but again, like the S&P, it's not improving.
No, and it's not up the pre-COVID levels.
Yeah.
Hasn't reacquired those. The ISM services business activity is actually looking quite healthy and slightly above expectations. And the ISM services employment is, it's interesting, isn't it? That you would expect that the employment would be showing something similar. It looks slightly out of kilter. Maybe they're getting more efficient because they're using AI.
Yeah, well, absolutely.
ISM services new orders. It's in that range, and that range is below the pre-COVID range.
Yeah.
ISM services prices paid, sudden, rapid, sharp decline, and one wonders whether that's a data point issue.
Yeah, I suspect both last month and this month are
Yeah.
just, bad data points, frankly.
Yeah. And we've got a weak ISM employment survey, and that is normally a good signal, as you'd expect, for a slowdown. And that is quite a consistent downward trend there in that data, isn't there, Keith?
Yeah, so this is the average of the manufacturing and non-manufacturing employment index. And, it has been negative actually for a little while now.
Yeah.
Now, normally that only happens at the start of recessions, but as we've been reporting for months, the non-farm payrolls.
Yeah, the recession isn't starting.
No, absolutely.
Apparently. Yeah. So this is the ISM Services Supplier Delivery Times Index, and so below 50, we have a faster deliveries, and which either indicates huge efficiencies in these in the delivery services, or they've got fewer deliveries and therefore they can make them more quickly. Which is it? Well, it's probably that there are fewer deliveries to be made.
Yeah.
Yes, demand is falling.
Yeah. So the general side, going through all that data, it's like the US economy, everyone's expecting a cyclical upturn, but we're not really seeing that. If anything, it's kind of flatlining, slightly slowing a bit.
I would agree with that, Keith. It's flatlining. Some data suggests that it's reasonably healthy. Some data suggests that it's falling. There's no data that suggests that it's growing powerfully now. And the Richmond Manufacturing Index is, again, it's following that fairly steady. It's been in a range. It's been in a range for the past 12 months. You could argue that it's in a slowdown trend. Kansas Fed Manufacturing Index also down and significantly below expectations. The Richmond Fed Services Index, better than expectations, but not a particularly good reading. And for the last 12, 15 months, it's been in that range between -25 and just above zero. The Dallas Fed Services Index, it's the same thing, really, isn't it? It's in that range between -25 and zero. So the Chicago PMI is a lot worse. And that's 2 months in a row that it's been very poor.
Yeah. Now, several things going on here. First of all, over the course of last year, these PMIs, the regional Fed surveys, I think we can say they've been consistently weak, despite the fact, actually, the US economy has been going absolutely great guns. So you have to question how accurate they are as a guide to the economy. But they're also showing a very different picture from the ISM or the S&P Global. They're showing consistent weakness. So, it's not clear if the markets are expecting the US economy to start accelerating. I just can't see it from the data.
I would agree, Keith. I think, and if it were accelerating, you'd expect to see these surveys giving some indication of that, and they're really not doing so.
Yeah, I agree.
And the Case-Shiller House Prices Index is now negative for 3 months. That was month on month. Year on year, it's still positive, but you'd expect then 3 months of negative data to start to see that turning over. Redbook retail sales, and we discussed this a little while ago, and the retail sales looking very strong at the moment.
Yeah, that's a good trend.
Yeah. And the 30-year mortgage rate, 6.91%. It's just hovering around that 7% level where it's been for the last 12, 14 months, I think, maybe longer. The mortgage market index is flatlining at that really low level.
Yeah,
and it's not getting up.
Yeah, dead as a dodo.
Yeah. US initial jobless claims bang, I would say, bang in the middle of the range that it's been in since August, September last year.
Yeah, absolutely no sign of a pickup in unemployment.
Yeah. Continuing jobless claims, again, nothing remarkable there at all. But this is a bit of data that shows that US unemployment has risen by 1 million. But there has been no change in jobless benefit claims.
Yeah. So, some contradictory data. Actually, it's not quite a million, the blue line, but still, it's risen a lot. And initial claims have gone absolutely nowhere.
Yeah, interesting. The Dallas Fed weekly economic GDP estimate is at 1.8%. It's I mean, basically, again, that estimate has now been fairly stable for getting on for a year and a half.
Yeah, but you see, again, it's been drifting down over the last quarter.
Yeah.
Although, frankly, it never got to the 4 point, whatever it was percent. Very strong growth you had in Q3.
Yeah. The Atlanta Fed GDP now for quarter one showing 2.8%, which is a pretty healthy rate of growth. And the Citigroup Economic Surprise Index. So this is the Indeed job postings reported, which is continuing to decline.
Yeah, and I think that's fairly consistent with JOLTS, isn't it?
Yeah. So the non-seasonally adjusted trueflation, 2%.
Yeah, this is great because, previously it had been trending up and we were getting more concerned, but then kaboom, bang. Although, as we reported in previous weeks, they tend to revise the entire data series quite regularly.
Yeah.
So
this is the projected US federal budget deficit, which shows the primary deficit, excluding interest, dark, fairly constant, and the interest outlays are rising quite steeply for the next many decades. And this is why the Fed, in order to help the US government get out of its fiscal hole, needs to get interest rates down or start QE, which it sort of is in some senses anyway. Although,
well, more on that in a bit, Richard.
So, but it's a real problem for the US government, this high interest rates.
Yeah.
The other thing they're doing, they're issuing a lot of short-term debt.
Yes.
And short-term debt attracts the current interest rate.
Yeah, that's right. They don't want to lock in, the current high long-term rates. Because the thing is, if you issue T-bills, then yes, you're paying high interest rates now, but they're expecting to cut rates and they don't want. So they're basically saying they think long rates are too high.
So there's a Federal Reserve posted a record loss of 114 billion, which presumably is loss on its bond portfolio. Yes. And it doesn't matter though, does it, Keith? It's a nice business to be running.
Yeah.
So to summarize all of that lot with fewer, the JOLTS jobs report, openings report, the whole series has been lowered. So the fewer job openings than had been believed. So we've got PCE inflation is below expectations. Construction spending is now query consistently falling. S&P Global Manufacturing Services weakened in March. The ISM manufacturing showed growth in March, but services weakened. And Fed surveys for March pretty weak. So where is the US economy now? Is it actually slowing down from what it had been, from the sort of red hot economy that we appeared to have over the last 12 months?
Yeah. Because the thing is, the market seems to be expecting a cyclical upturn.
Yeah.
But, the data we're seeing is not supporting that. No. So watch this space.
Yeah, exactly.
Finally, on to China. So we had the PMIs and they were all good. So the NBS, National Bureau of Statistics, that's the official numbers, manufacturing rose into expansion territory at 50.8, and that's quite a sharp rise on March. The non-manufacturing also rose sharply to 53, beating expectations. And so the composite rose to 52.7. And that is a decent number. So according to the official PMIs, the Chinese economy is doing okay. According to the private Caixin PMIs, manufacturing again rose, slightly beating expectations. The services also rose slightly, and the composite also rose slightly. So the Caixin is showing Chinese economy also doing decently. But slight caveat, March is always a good number. So there's quite strong seasonality in the PMIs. We'll have to see how the data evolves over the coming months. And we know that China has been investing a lot in industrial capacity because obviously the residential and construction market is struggling. As we've covered many times, well, there is a limit to how effective your industrial investment can be. So this is Chinese solar cell manufacturing. And so you see that the dark blue bars are global PV, photovoltaic cell installations, and the blue bars are Chinese manufacturing capacity. And so basically China can manufacture far more than the world can absorb. And during the week, Bloomberg were showing that some in Germany, these solar panels were so cheap, people were using it instead of fencing.
Yes, I saw that.
It can't be, I'd be amazed if that's profitable.
And the other thing I would just like to say on that, Keith, is that these solar panels use polysilicon, which is created by burning the reacting silicon with coal, and it produces vast amounts of carbon dioxide. So I would like to know what the actual break even for these solar panels is in terms of their required longevity. And I suspect they'd probably never break even in carbon production.
I think you might be putting your hand up to be burnt as a witch by the green lobby, Richard. So, but the PMIs all strengthened in March, but that may simply be seasonal. With China, it's impossible to tell because they lie about all the statistics, frankly. Okay, a bit of a cheat for one chart this week because it's not one chart, but it's really interesting and important and actually has huge implications for the global economy over the next few years. So Goldman Sachs have been discussing the increase in labor productivity that arises from investment in artificial intelligence. And the numbers are really astonishing and important. So academic studies have shown that using generative AI increases labor productivity by between 16 and 25%. Company anecdotes reporting a median or an average consistently around 25%.
That's a really interesting chart, Keith.
Yeah, they're amazing numbers. And the majority of US workers now have used AI. I was very, very surprised at this. Look at the chart on the right. 55% of US workers have now used generative AI at work.
I just would put a little bit of a caveat on that in that one wonders quite what the data source was, because there've been an awful lot of workers who won't ever touch generative AI because they're not basically clerical workers.
Yes, I completely agree. Absolutely. Your janitor's never going to use that. Yeah. So that's, of the people who could possibly use generative AI, that's a much higher proportion.
Yeah.
But you notice that monthly visits to ChatGPT have stalled.
If you look at the internet bubble, any company that was setting up a website, this is back in sort of 1998, 1999, was the shares were chased incredibly high because of everybody thought that it was going to it was going to be a transformational change to their business.
Mhm.
And we've sort of got the same thing happening here with AI. And the question is this froth that is going to actually fall away, and then the genuine use cases of AI will start to come to the fore, just as Amazon actually came to the fore after the tech crash. Apple did, etc.
Yeah.
So that's Facebook, Google. Is a similar sort of thing actually going to happen with AI? The froth will come off, and then.
So I think we've been saying before, and I stick to this, that technological change generally takes many years.
Yeah.
And for companies to fully integrate it into their systems and become more productive. And I think that will remain the case, although this time that change could be accelerated, particularly for knowledge intensive industries. But so far, this chart shows that the AI revolution has really not resulted in many job losses, although frankly, the 2-month trend is not looking very good, but those are small numbers. And so far, this slightly contradicts what we've been showing earlier, with 55% of US workers having used AI, but only around 5% of US companies have adopted AI. So there is a long way to go. And that means that uplift in productivity has not happened yet.
Of course, to just draw your point, draw you back to what I said the other week, Keith, where I have used AI on eBay, and it was dreadful.
Yes. Yeah, and I think there's a lot of small companies that possibly could benefit from AI, will not know necessarily how to do so, and it will take quite a long time for that knowledge to disseminate into the economy. You need some specialist, consultancies to set up to show small companies how to use it, how to train the models, etc.
I
So,
think that is spot on. I think it's much easier for large businesses to incorporate it than it is small businesses.
and all that is going to require a very large investment in hardware and software, actually. So, but given the uplift in productivity, all of that seems very manageable. This is labor market productivity. Is it any coincidence that over the last couple of years, finally it's showing a bit of life, having been stagnant for years? Finally, this is Klarna. So Klarna have adopted AI to deal with its customer service function, which is now a chatbot. And the results have been incredible. So it's now gone live globally for 1 month. It's had 2.3 million conversations. That's 2/3 of its customer service chats. And that's doing the work of 700 full-time agents. The satisfaction scores are on a par with human agents. It's actually more accurate in its dealings. So there are 25% fewer repeat inquiries because it gets it right first time. And customers have resolved their queries within 2 minutes as opposed to 11 minutes previously. So Klarna are estimating that's going to save them 40 million.
I saw something interesting the other day, Keith. I don't know if you came across it. That apparently you can get language translation software now. That means that if we wanted to broadcast this in 5 different languages, it does simultaneous translations into those languages with lip syncing.
Wow. You mean it's going to model our faces, Richard? That seems a thankless task. Anyway, so the implications of this are absolutely huge. And it's something I think we're going to have to return to again and again, because this could actually have a huge impact on the world economy. Because the implications are that you're going to have a 25% rise in output per hour worked for companies that incorporate AI. So that means they won't need additional staff. Essentially, there's going to be a supply shock for personal services, so information services.
Yeah.
So
So what also happens though, Keith, is that the first mover gains a profitability advantage.
yeah,
But then all the competitors have to do the same thing.
yeah,
So the pricing then drops back down to the normal pricing level. Profitability drops back to the normal level, but everybody's using AI. So you have increased productivity, but you don't have super profits over a prolonged period.
true.
So what does that do to economic growth?
Oh, it boosts it. Absolutely. Productivity growth is economic growth.
Yeah.
If you can all produce more.
But what about the unemployed? What about the people who lose their jobs? What do they? Because
Well,
if you have fewer people, then you simply have fewer people doing more productivity, if you see what I mean.
well, the thing is, Richard, I'm not convinced that there's going to be a huge rise in unemployment from this. Because if you think about the accountancy profession and the implementation of the first spreadsheets, we talked about this a few months ago. So what happened in the early 70s was the first spreadsheets came in, and there were then 400,000 accountants. And suddenly accountants became vastly more productive. They didn't have to do all these calculations on mechanical calculators.
Yeah.
And they were the first adopters. And everyone was thinking, well, this is going to put a lot of accountants out of business. But the number of accountants in the US has risen from 400,000 in the early 70s to 1.2 million now. And actually what happened was accountants became, their services became cheaper in real terms, and they became more productive. And so demand for their services has just kept on rising. And for things like law, you think that hiring a lawyer is just ludicrously expensive currently. And there's a lot of legal work which is not done because people just can't afford it. And if legal services were to fall in price, I think there'd be a more than offsetting increase in demand.
Yeah. Yeah. I would like to see these charts again in maybe 6 months' time.
Yeah, absolutely. So, but this has huge implications for actually investing. So it would be hugely bullish for equities, particularly in information intensive industries like accountancy. They can do more with fewer man hours. So corporate profitability will rise, but as Richard says, eventually that will come back down. However, the sectors that won't benefit are those with large amounts of manual labor that are not susceptible to substitution by AI. So basic industries, basically, basic materials and industries. It is less bullish for bonds, but it's also good for bonds in that lower supply shock should lower prices and therefore reduce inflation. Higher productivity is very good for inflation, but there will also be an increase in demand for investment, for all the investment needed in AI, which could potentially lift rates, increase demand for savings. And finally, it will be bullish for selective commodities like tin.
I would add copper into that.
Yes, I'd add copper as well, actually. Yeah.
But yeah, interesting.
So, yeah, interesting. We will be returning to this space, but the AI revolution really, as you've seen from that chart, only 5% of US companies have actually implemented it, and presumably not to the full extent they will be able to in future. There's a long way to go, potentially a big uplift in productivity coming down the pipe. That's great for the world economy, great for equities. Okay, now, warning, this is a big section coming up, but I think it's quite important. And one of the pleasures of doing this podcast is that very well-informed viewers get in touch and offer a counterpoint to points of view that I've put forward. And in some cases, they turn out to be absolutely right. And that is the case with China's current account deficit. So thank you to Mr. C. Peckham for getting in touch. And we have previously talked about how China is saving far too much, and that is a negative for the world. You remember that Ben Bernanke's explanation for why the great financial crisis happened was a global savings glut. So we showed you this chart a few weeks ago. Chinese savings as a percentage of global savings is 28%, which is almost equal to the US and EU combined. And according to the national accounts formula, pause, take a look, savings equals investment. But that's true for a closed economy, such as the world. For an open economy, it's equal to investment plus the current account surplus. And we know China is running an absolutely enormous current account surplus. So therefore, China's investment level as a percentage of GDP is absolutely unprecedented in world history. It's down from its peak, but still an absolutely enormous 40-odd% of the GDP. So the question is that good or bad for the global economy? And previously, I had said it's very bad for the global economy because China is essentially stealing demand from the rest of the world. So China is propping up its economy by exporting, taking advantage of external demand to prop up the internal economy. And we've covered this before as well. China's current account surplus may actually be even larger than they are reporting if you take the customs data. So the investment level may be even higher, which, according to my previous pronouncement, would be even worse for the global economy. An example, this is China's current account position in cars and auto parts, which has gone from deficit to huge surplus as a result of their investment in electric vehicles. So previously, we've been saying that the massive Chinese current account surplus means it's exporting savings to the rest of the world and using its external demand to support its economy, which is good for China and bad for the rest of the world. And here you see that, recently the trade surplus has just been absolutely enormous and getting systematically bigger, which, we were saying was going to be bad for the world economy. But, and this is Mr. C. Peckham's point, if that's true, then how come unemployment rates in the world are really low and falling? There's no sign that China's stealing demand from the rest of the world, actually. Now, it is true that rising Chinese industrial exports have led to falling industrial production in the West. So the red line is Germany, the green line is the UK. And you can see that as Chinese industrial production has been growing, so European industrial production is going nowhere and in decline. But that is not necessarily a bad thing if those workers are moving to other more productive areas of the economy. And the Bank of England was saying just that workers had been shifting from low productivity sectors to high productivity sectors. So according to traditional economic theory, how does the current account imbalance, such as China's, affect global and regional growth? There are three channels. First of all, there's a savings channel, whereby a big current account surplus implies a big export of savings to the rest of the world. And you remember that Ben Bernanke had blamed the great financial crisis on the Asian savings glut that artificially reduced interest rates around the world, leading to malinvestment. Although, as Mr. C. Peckham points out, how can you have a savings glut, given that implies there's an investment glut? Well, actually, if you have a lot of malinvestment, you can have an investment glut. And second, there's the competition channel. So we have very high current account surplus in China because they're artificially depressing the value of the yuan. So that means workers in competing industries elsewhere in the world will struggle to compete. And finally, there's the trade channel, whereby China's large goods trade imbalance in finished goods actually could be positive for the rest of the world, in that that leads to them importing a lot of unfinished goods, etc., and intermediate goods. So what channel dominates? Is China, the big question is China's current account surplus good or bad for the world? Now, previously, I've been saying it's bad for the world because you're stealing demand. And I've been very influenced by Paul Krugman, whose book, The Return of Depression Economics, I've read a couple of times, and in it he blames the problems in the Eurozone on Germany and its current account surplus, and saying that the German current account surplus is bad for the rest of Europe. And so I was saying that the Chinese current account surplus was bad for the rest of the world. It steals demand from the rest of the world. But, well, the IMF have investigated this, and actually they find that is not true. They find that the Chinese current account surplus is good for the rest of the world. An increase in the Chinese current account surplus leads to a rise in regional and global growth. Also, actually, a decrease in the current account deficit for some current account deficit countries is also good for the global economy. So if the UK were to reduce its current account deficit, that would also be good for the world. However, a reduction in the US current account deficit would actually be bad for global growth. Reminder, the US runs an absolutely enormous current account deficit. So the IMF is saying we shouldn't worry about it. It's good for the world. And so these are some of the charts from the IMF paper, and this is China. And you'll see this is the effect of a 1% to GDP shock in the increasing the Chinese current account deficit, and that increases both the regional and global economic growth. So this is the effect on regional growth, and that's a very strong impact on regional growth of over 1% if China increases current account deficit by 1%. So obviously, China is a much bigger economy than most of the rest of East Asia, so they benefit disproportionately. Global growth also rises actually by a decent and surprising amount. Now, if the UK were to reduce its current account deficit while maintaining GDP, i.e., it increases its exports, that would be good for regional growth and actually have a similar effect on global growth. Now, you'll be asking how both of those can be true. How can both China increasing its current account surplus and the UK decreasing its current account deficit be good for the global economy? Well, what it's saying is essentially increased trade is good for the global economy. In both of those cases, trade, i.e. exports, increase. If the UK were to cut its current account deficit due to recession and reducing its imports, that would be bad for the world economy. Now, the picture is not the same in the US. If the US cuts its current account deficit, that actually leads to a fall in global growth. This is regional growth, and you can see pronounced drop. And that is despite the fact this paper assumes that the current account deficit is cut by the US increasing exports. And this is global growth, and it's even worse. So it appears that the US current account deficit is essential to global growth because of the role of the dollar in the world economy. And so the US current account deficit is needed for the circulation of dollars in the world economy. Thank you. In conclusion, thank you very much to Mr. C. Peckham for getting in touch. And my previous prognostication that the Chinese current account surplus was bad for the world turns out not to be true. More trade is good. And in particular, when the labor markets around the world are tight, then China is doing additional work that could not be done in the West because, frankly, we don't have the workers. So the Chinese current account surplus is a win-win for everyone. Richard, any thoughts?
It's interesting, isn't it, Keith? I mean, the movements and flows are very complicated. One comment I would say is that it says the US current account, the US deficit is good for the global economy. But there's a question mark as to whether it's good for the US. And it is becoming apparent that for possibly extraneous reasons, it's not good for the US. So this weaponizing, because it has the global reserve currency, it's weaponized its global reserve currency. So trade transactions moving away from the dollar. All of that then makes having this massive deficit more and more dangerous for the US.
Well, okay, there are a couple of caveats, which comes to your point, Richard, in that the Chinese current account deficit, which is rising, can only continue as long as it is willing to accept a continual flow of credit from the US in return for financial or physical assets. So China's becoming more and more of a creditor, US more and more of a debtor. At some stage, surely that has to end.
And China doesn't want US treasuries, basically, because it sees them, I suspect it sees them in two ways. One, it actually doesn't particularly politically wish to support the US. And secondly, it doesn't want to be sanctioned and have those treasuries frozen. So that's one of the reasons that China is buying gold, I believe.
Yes.
And of course that then makes the US dollar less of a reserve currency, which means that it can't maintain or shouldn't maintain. It would be bad for it to maintain its deficit. And so it's like all of these things, isn't it? It sort of works within a given size, but when you have significant extraneous factors or the size becomes too large, then other distortions start to appear that could cause the whole thing to break.
Yeah.
Now, I'm not saying it's breaking at the moment,
but
I think that is the danger.
Yeah. Okay. But the bottom line is now China is doing a lot of the work that is most productive in. And so the world economy is it's good for the world in that
we're all benefiting from having fence panels made out of
yes, well, they're dirt cheap, Yeah. So finally, thank you to Mr. C. Peckham for getting in touch and correcting me on that. Very interesting. Not what I had been taught.
So why could the US growth accelerate from where it is now? If we have inflation that continues to fall and we have interest rate cuts, then the credit cycle begins and we have more borrowing, we have a credit impulse, asset prices then rise, and we have that virtuous circle that we've seen before, animal spirits and so forth. And so that's a potential outcome of interest rate cuts. And then as the wealth effect comes through from rising US equity and house prices brought about by interest rate cuts, spending in the economy increases, which further boosts the economy. So economists estimate there's a 3 to 5% increment in consumer spending for every dollar in wealth created in the economy. As the economy grows, there's more pressure on supply of jobs, productivity has to increase, and in addition, as we've just discussed, we've got now have the benefit of AI coming through, automating those functions and increasing further the overall profitability, particularly at present, of clerical staff. I mean, I suspect we'll find manual labourers become more impacted by AI maybe in the next couple of decades. So we have falling mortgage rates because of the interest rate cuts, allowing the housing market activity to come back. And as we have turnover within the housing market, that drives a great deal of the durable goods purchased by consumers. And that again boosts the economy. So basically, this is sort of predicated on that reducing interest rates will cause an economic boost. And as the manufacturing cycle turns, because demand goes up, manufacturers raise output and hiring. And that's the sort of theory. What's the next one?
That's it.
That's it. Okay. So what could go wrong is the question there, Keith, isn't it? Because that's the classic theory of why it's the opposite of raising interest rates. When interest rates start to fall, the US goes into that virtuous cycle.
Well, this is what should happen. But the market seems to be slightly premature in its assumption that we're going to have this cyclical upturn, because it both thinks that interest rates are not going to fall because the economy is strong, but then we're going to have a cyclical upturn. Now, when it would seem to me that you're not going to get interest rates to fall unless the economy cools down a bit first. So yes, this will eventually occur, but not necessarily yet. And, when we look through this week's data, or data of the last couple of weeks, it seems that actually the data shows the US economy is not strengthening. It's, if anything, weakening slightly.
Which, of course, is a desired effect of raising interest rates.
Yes, absolutely. But, again, markets are off to the races on the back of, expectations.
And are they being premature in their timing, expected timing of this?
Yeah.
Yeah.
And on to inflation watch, Richard.
Thank you, Keith. So some new numbers. The EU CPI 2.4% in March, and core CPI 2.9% in March, both down. And in Japan, both rates are up 2.8% for CPI and core CPI. That was a revision of the February data, actually, wasn't it, Keith?
So no, I'm just saying those are the January numbers, and the leap is astonishing.
Oh, right. Okay. So yes, that is. So Japan has got the inflation it's been wanting for forever.
Yeah, because we were previously questioning whether they could keep inflation above 2%. Well, bang.
Of course, one of the problems they've got is the Japanese strength and weakness of the Japanese yen, isn't it? So import prices must be very high in comparison with how they were a couple of years ago. So here we have Japan CPI year on year, which has basically been bumping around 0, and 1 for a decade, and now it sort of spiked up in 2023, fell back down. Is it going to go back up again? That is the question.
Yeah. Now, we previously talked, Richard, about how Japan should be very careful what it wishes for, because if it does manage to get inflation up, then presumably real yields rise, and its enormous debt burden becomes totally unsustainable.
Yeah.
So
work that one through.
Yeah.
That's a challenge to our viewers. Work that one
exactly.
through.
Let's see what happens there.
Yeah. You need a bit of AI to work out what's going to happen there. I have to model the whole world. So the Taylor rule estimate of US neutral rates is currently 4.4%, which is below the current rate. And the question is, at what point? I mean, I think everybody believes the Fed will cut rates over the course of the next few months. The question is, at what point will it cut? It's very key not to appear to be interfering in the political process, isn't it? And we discussed that the other week. And it's also very keen not to look stupid if it gets this wrong, because it made itself look very stupid with transient inflation.
Exactly. So they're being cautious. And actually, so US interest rates are tight, according to the Taylor rule, for one of the few occasions in recent years, basically.
Yeah, there's not a huge difference, is there, Keith? I mean, there's what is it? Is it 0. It's a 1%. Yeah.
Yeah. But I mean, this is, real interest rates are rising. So
Yeah.
monetary policy is actually getting tighter as inflation comes down.
Mm. In the US, CPI inflation is accelerating, and this is CPI core, which is 4.4% over the past month, 4.2% over the past 3 months, and year on year, 3.8%.
Yeah, so it's an open question whether this is seasonal. We know inflation tends to rise in the early part of the year. CPI is seasonally adjusted, but it's a question of whether it's seasonally adjusted enough. Now, the Fed doesn't think so.
Yeah. And multivariate core, PCE, fell in February, and the trend with all of those actually is continuing downwards. So
yeah. So what they're saying is, and this is, not opinion. This is the model taking all the data, and it's saying the broad mass of the data continues to fall. So that's good.
Yeah. And US financial conditions have eased, and so the light blue line is the CPI year on year rate of change, and the black line is financial conditions year on year, and that is inverted. So financial conditions have gone from sort of 0 to minus 1.5, which is a loosening.
Yeah.
And as points out in this slide, loosening financial conditions should act as or remove or reduce barriers to inflation. So one might expect the inflation rate to increase.
Yeah, concerning. Although whether the causality runs, which way the causality runs is open to question.
Yeah. So UK inflation over the long term shows that inflation targeting, i.e. actions by the Bank of England to reduce inflation, has been, I don't know if it does show that, does it? I'm just going to, as an aside, does it show that?
Yeah, I think it does. So, we had the implementation of inflation targeting in the early 80s.
So but what was the target in the early 80s?
Well, it was 2%, but you started the decade at 18%. And so I managed to cut off the dates at the bottom. That's like 18%. This is the 70s. So, it took a while for inflation to come down. Actually, it came down really.
But I remember, wasn't Mervyn King had to continually write letters to the Chancellor of the Exchequer explaining why inflation was 3% and not 2%?
Yeah, that's right. But since then, in the 2010s, 2010s, it's absolutely bang on target. And
so was that inflation targeting, or was it good luck?
I think it was definitely inflation targeting, where it's also expectations.
Yeah.
If everyone's expecting inflation at 2%, then your wage demands are lower.
But I don't think you can look at this in isolation, Keith, because what we do know is that the absurdly low rates of interest that we had after the GFC caused massive misallocation of resources. And that may well be one of the reasons why the UK economy is in such a mess now. So even if they got their inflation targeting right, and I'm not saying that, I don't necessarily give them credit for that, the mess they created with these very low interest rates is still with us.
No, I agree with that.
Yeah. Sorry, I'm just not as I see it as being a bit more complicated.
Okay. Yeah.
So if you used pre-1983 inflation calculation methods, US CPI would currently be about 8% and would have gone up to 18+%. And the question, I guess, the question is which one is right, isn't it? Which one is the most appropriate measure? And I don't know the answer to that question. Do you have a feeling for that, Keith?
No, I don't. I just find it, it's interesting.
Yeah. Are we being manipulated? Because we've got hedonic adjustments as of to far greater extent than we used to, haven't we?
Yeah.
So the price of a TV has dropped because you get a lot more out of your TV than you did 15 years ago, but actually it's more expensive. Let's work that one out if you can.
Yeah. Well, just put that out here, conspiracy theorists can, Take them what they will.
I didn't have you as a conspiracy theorist, Keith. So apparently the CIA introduced the term conspiracy theory to debunk what they consider to be threats to their activities. Bit of psychological warfare. So if you have anything you don't like, you call it a conspiracy theory, and you can dismiss it, and the person making that theory as being a crank. And that's not a conspiracy theory. UK EU inflation is continuing to reduce. I agree with Keith. It's on target to hit the 2% in the coming months. I agree with that. Has it got another resurgence in its tank? I don't know yet. We'll see. US inflation suffered a little bit of a setback in recent months, and the Fed seems to believe it's to be due to seasonal effects and that it's going to resume its downward trajectory, which the multivariate core trend that we saw seems to concur with. So we shall see.
We shall see. Okay, and on to Recession Watch. So Recession Watch has had a bad few weeks, and that there hasn't been much to show that there's the economy may be slowing down. But actually, now it looks like the US economy is certainly not improving. And when we look at the US fiscal impulse, the fiscal impulse has actually peaked. So the US fiscal deficit actually subtracted from US growth in Q1. And when you look at state and local governments, their expenditure year on year is in black, and it's been rising strongly. Their revenues have been falling. So at some stage, they're going to have to start cutting back on expenditure, you would think, which is going to add to the fiscal drag. And all this is happening against the backdrop of, everyone no longer believing that there's going to be a recession in the coming years. So, most fund managers don't believe a recession's coming. And hence they're bullish on equities, bearish on bonds. But the yield curve is less optimistic. The blue line is Bloomberg's survey of professionals. The black line is the bond market. They still think there's about 55% probability of a recession. But over the course of the last year, all the leading indicators have been predicting a recession, and it's just never come. And that is really anomalous, actually. And has certainly caught me out. But bank lending growth remains very weak and may be getting weaker. Capital goods orders are going nowhere and not improving. The San Francisco Fed has updated its latest estimates for excess pandemic savings, and it shows that they're gone. So, finally, are we seeing the US consumer exhausted and needing to pull in its horns? And the credit impulse in the US remains strongly negative. So, now that nobody believes that there's going to be a recession in the US,
except us.
Yes, except for me, the US and consumers appear to have finally exhausted their excess savings. The fiscal impulse is negative. The credit impulse is negative. Construction activity appears to have peaked and has negative the last 2 months. So
Keith, when we finally get the news the US is in recession, we'll have to pop a bottle of champagne.
Yes, exactly. Well, when I finally get out of this disastrous gilt trade because the world goes into recession, then I shall be, leaping around for joy. And on to quiz of the week, Richard. You ready for this?
I'm ready, yes. Ask away.
So, within our lifetimes, which Western European democracy experienced an armed insurrection with militias roaming the streets, closing businesses, and enforcing a general strike that they'd called, leading to the government losing control of the streets and quickly capitulating? Western democracy, European democracy within our
Spain?
lifetime.
Spain?
No, it's us.
Us?
Yeah.
Oh, wow, yeah. Gosh, Northern Ireland.
1974, Northern Ireland. So in 1974, there was the Sunningdale Agreement, which was a power sharing agreement between Britain and Ireland to try and resolve the troubles. The Unionist Ulster Workers' Council then brought Northern Ireland to a standstill. The army refused to step in because they did not want to be fighting both the Republicans and the Unionists. And so the government of Harold Wilson capitulated and restored direct rule from Westminster.
Oh,
And we forget about that. We forget what a total mess Britain was in the 70s.
yeah, don't we just?
Okay, and onto other charts, Richard.
Thanks, Keith. How couples meet in the US, technological change. So online, look at that. From 1980, nothing, to pretty much everybody these days. I remember one of my children, when that would have been 5, that was quite a long time ago, and one of his school friends, his parents met online, and I remember being quite shocked. And now it's the norm.
Well, I used to think that they must have been a bit desperate.
Yeah.
But now, you know, everyone does it.
Now everyone's desperate, Keith.
That's true.
Global government debt has exploded since the GFC, and something's going to go wrong with it, isn't it? We just don't know what or when, but just look at the gold price.
Yeah, well, I agree with that.
The dead weight of bureaucracy in one chart.
Okay, so let me explain this, Richard, because
Yeah.
actually you'll like this, because this is your point. So in France, there are various rules that apply to big businesses, and a big business is defined as having a headcount bigger than 50. So then you get a whole load of extra bureaucracy about, you know, having workers consultations, etc., and presumably diversity officer and all that nonsense. So this is the number of firms by headcount, and you see, like,
drops off a
nobody
cliff.
wants to hit 50.
No.
It's like, the moment you get to 49, it's like, right, I'm not hiring anyone else.
No. And who would blame them?
Right, absolutely. So, you know, this your point about how the US is a much more dynamic economy than Europe. There you go. That's
The
it.
problem is the state wants to control everything.
Yeah.
And that's not compatible with a vibrant economy. You
Yeah.
know, you can't do it. You have to pick the few most important things.
Mm.
Okay.
And on to good news. Our brains are bigger than our ancestors.
Yes.
Okay? So, a long-term study of people in Massachusetts revealed that compared to the World War II population, i.e., when this long-term study began, people today have brains that are 6.6% bigger, 6.6% more dense, with a 15% larger surface area. And therefore, modern people may be better able to avoid dementia.
Are we more clever?
Actually, you know what? I'm pretty sure we are. And so they're saying that lifestyle choices are related to health, social activity, cultural behavior, and educational attainment may play a role in determining brain size. And, you know, when you get kids, you know, 5 to start playing video games, you know, everyone thinks video games are bad, but actually that is a lot of stimulation you're giving young children. Sorry, go on.
No, you finish, Keith.
And separate studies have found that the incidence of dementia is dropping by about 20% per decade since the 1970s. So that's all great news, frankly.
So it's quite interesting. The elephant brain is much bigger than ours even, but we're not as we're more intelligent than elephants. So I suspect the brain size doesn't affect intelligence, but it affects the redundancy.
Well, I think the other studies have shown that bigger brain is associated in humans with more intelligence, but it's also the density and the amount of cross connections.
Mm.
So I'm optimistic, mate.
I think you should be, Keith. One of us has to be.
Yeah. And on to equities, Richard.
Thank you, Keith. So equities was a poor week for equities. In the FTSE All World Index, down by 1.4%, but still consistent with that pretty awesome uptrend.
Yeah.
The FTSE All Share didn't have a poor week, had a good week. And the FTSE has actually had, for a change, it's having a good year, 2.7% on the year.
Yeah. I should say all these numbers over the past 2 weeks. We were away last week. I was away.
And the Euro stocks continuing to climb. S&P 500 didn't have a great week, down 2%, nearly 2%, still up 8% on the year.
Yeah. All of these numbers are from pre-open on Friday.
And the NASDAQ, as Keith referred to in the opening section, is actually significantly down this week, down 2.4%, up 7% year to date. The question is the NASDAQ, and it's too early to say from that, is the NASDAQ sort of rolling over a bit after its tremendous run?
Yeah. What do you're the technical analysis guru, Richard. What do you think?
Well, I think if you just sort of on a line basis, it's dropped below the uptrend. I think you need to start looking at things like momentum and so forth to see what's going on under the surface. I suspect that it may be topping out.
Yeah.
Now, the Russell 2000 is almost unchanged on the year now, actually down 2.3% on the week. The Hang Seng is down on the year and not following the trend of most of the other markets. And the Topix was, gosh, down 3.3% on the week. But having said that, it was up 14% on the year. So,
yeah. Everything just taking a breather.
Yeah. As is Bitcoin, really, which has sort of been fluctuating at the current level now for a few weeks.
Yeah.
And the pound against the dollar, basically, it's in this big range of 121 to 132, and it's bang in the middle of it. Very unexciting. And the euro against the dollar is doing pretty much exactly the same thing. And the dollar index, not surprisingly, doing the same thing again. People get very excited about the dollar index, but I can't see it going anywhere until it gets to exceeds the parameters of that range. The VIX, however, up 27% on the week. Have you still got your VIX holding, Keith?
No, I basically lost loads of money on it. Well, it was a tiny position.
Yeah,
I closed it, but it didn't work.
It's timing, isn't it? Timing for these things is just impossible. And what's he going to do next week?
Yeah, cost me money. And that still is not a very good number. It's not high by any means.
The problem with the VIX is it's so hugely geared, isn't it?
Yeah.
And this is the NASDAQ versus Fed rate expectations, and the jaws will close. How will they close? That's the theory. I think they will close.
Yeah.
Will rates fall or will the NASDAQ fall? Stocks have not. This is really saying that although we've had interest rates go from 0.5% to 4.25% in 18 months, and no, not in 18 months, but the stock market hasn't really reflected that change.
Yeah.
At all. And as we've discussed many times, because of the strength of the US economy and the IRA and the CHIPS Act, put a huge amount of money into the US economy. And this suggests the US market may be looking overvalued if you look at market cap to GDP historically.
Yeah.
2024 stock market winners and losers. Tesla is slowly normalizing, isn't it? You remember it was ridiculously overvalued. Now it's only stupidly overvalued. It is slow. You can see it's going to come back down to being a car company.
Yeah, but it's going to take time. It's still, to my books, it's got a long way to go. I think it's still 3 times overvalued.
Yeah.
But congratulations to everyone who held Nvidia in Q1, up 82%.
Yeah.
Well done.
Very good indeed. Yeah, so this is a chart that suggests that insiders may be selling the tech rally.
Yeah. And if so, their timing, at least over the last couple of weeks, has been pretty good.
Yeah, yeah, indeed. So this is a series of failed sell signals on the NASDAQ 100. And you can see there have been loads of sell signals, and really, you shouldn't have sold any of them.
Yeah.
Had you had a crystal ball.
That tends to be bullish, he says.
One of these days, so.
Yeah.
Or maybe not. High household asset allocation to equities suggests that the future returns may be poor if you go off this historical chart.
Yeah. And this is something we have talked about previously. Everyone is super overweight equities. That's bad.
Buying high, selling low.
Yeah.
We've all done it. And the market appears to significantly anticipate an upturn in the manufacturing cycle, which we talked a little bit about earlier.
Mm.
And so, have they got it right?
Yeah. It seems they've got ahead of themselves to me.
Mm.
You know, when we look at the data, it's not that strong.
No. And fund manager exposures to stock, they are leveraged long, and
Yeah.
that is possibly a sign of being all in. Small speculators are also all in.
Yeah. So it seems to me it's setting up for a pullback. You know.
Yeah. There's certainly plenty to squeeze out. The momentum strategies have performed very well in the past year because you buy the ones that are going up, and in the US that's worked very well.
Yeah.
So everybody is long momentum.
Yeah. It's just everything is stretched.
Yeah, yeah, agreed. But the 3-year return is still looking not excessive in momentum. But
Yeah. Yeah. But everyone's, positioning is really extreme.
yeah. And we talked about this the other week. There's forecast for Nvidia's massive annual revenue growth.
Yeah. So this is what's in the price.
Yeah.
Huge growth, which has been, over the last few years, it's been absolutely astonishing.
Mm.
Yeah.
Yeah.
But the market is extrapolating that hard. Thank you, Richard. On to commodities and brief summary. Well, energy had an amazing week, with Brent closing above $91. Industrial metals also had a great week on the back of strong Chinese manufacturing PMIs. And finally, precious metals also had a great week with gold up almost 5%. So commodities generally, great couple of weeks, actually, last 2 weeks. So if we look at Brent, it's up 6.4% over the last couple of weeks, up 18% year to date. Really not what the market had been expecting, not what I'd have been expecting. And WTI, the same, up 21% year to date. So on Richard's point about inflation resurging, input price in the form of oil is definitely resurging, but reminder, OPEC Plus have 3 million barrels a day plus of spare capacity that they are choosing not to use. So at some stage, you'd expect that OPEC Plus discipline starts breaking down.
Yeah.
Now, numbers specific to the oil market, well, crude had a build in the US. The inventories had a build. Still inventory draw on the year, but in the last couple of weeks, the US market has been oversupplied. The US oil production remains at 13.1 million barrels a day, 200,000 barrels a day below the level at the start of the year. So US production is forecast to grow in 2024. Right now, it ain't. It's shrinking. And Baker Hughes rig count fell by 4. Now, Goldman are reporting that US oil production is down by around 400,000 barrels from its peak. The numbers we've shown you previously are from the EIA, and they are saying it's down by 200,000 barrels a day. So if that's the case, then the oil market may be tighter than the EIA is saying. Moving on to natural gas futures. Well, in Europe, not much happening, frankly, down 17% on the year. All great news for European consumers. And in future, there's talk of reviving the Trans-Sahara gas pipeline, and both Algeria and Nigeria have made concrete steps towards implementing it. It'd be 4,000 kilometers long, which would transport gas from Nigeria to Europe and would also help European gas supplies. But we've been talking about it for years, still a long way off. But Abu Dhabi is investing in LNG. There's a lot of LNG and natural gas in the world. Do not expect a rise in gas prices in Europe. It's been a mild winter. We've cut down on our consumption. Gas storage levels are very high, the highest they've ever been at this time of year. Hence, low gas prices. UK natural gas prices down 18% on the year, down 5% over the last couple of weeks. Great news for the UK. US natural gas prices going nowhere, dead as a dodo. Coal continues to decline, down 12% on the year. Uranium actually ticked up over the last couple of weeks, but down 4.4% year to date. Has it peaked? Richard, industrial metals.
Well, that's a good week for industrial metals, wasn't it? Aluminium up 6.2%. Big rise there. And I read the little box there, but basically China's PMI surprised upside in March, as we know, and everybody is wondering whether China is going to start consuming large quantities of industrial commodities again.
Yeah.
And good exposure to that would be, I think, the China large cap ETF.
Yeah.
That's not a recommendation, by the way.
That's not a recommendation, no. We don't make recommendations.
It's more of an in-joke. Cobalt didn't respond, though.
No.
Copper did. Copper has had a good week and a good year, actually, up 8% on the year so far.
Yeah, copper doing well.
Yeah. And
China. Ignore this. We've covered this before.
Okay, so this is all copper supply demand dynamics. So we have here a forecast that copper is going to be a surplus in 2024, deficits developing later this decade, which is, I think, fairly consistent. It hasn't particularly changed, has it?
Yeah.
But as it goes into deficit, the price is obviously going to.
Later this decade, I think we're in real trouble with copper, but right now we're not.
Yeah. Chromium, a fairly non-event for chromium as well. Iron ore did not respond in the way you might have expected, though. Down 6% on the week and down 30% on the year.
Yeah. So, that's Chinese construction activity, according to iron, dead as a dodo.
Yep. Which is odd. Lithium is slightly sort of perking up a little bit. But lithium is also going to be rather adversely affected by the fact that consumers aren't desiring of buying so many electric vehicles.
Yeah.
And neodymium is just basically on the floor. Nickel, difficult to know what it's doing, really. I think it's quite a sort of managed market, isn't it, nickel?
Well, Indonesia are really ramping up production. It's difficult to see nickel going anywhere, frankly.
Yeah, I agree. There's tin, which, as Keith pointed out, could be a beneficiary of all the circuits required for a massive AI ramp up. And whatever's causing that, it's had quite a good year to date, 10% year to date.
Yeah. How long before, if the tin price goes through the roof, they kind of reverse the eco mandates and allow you to use a bit of lead in it as well? Because there's currently, basically 100% tin, but tin's a rare element in the way that lead isn't.
I don't think we're allowed to mention lead on air, are we? We should put the lead price chart on here, Keith.
Yeah.
Ferrovanadium, I just think it's
Yeah. Dead.
Zinc had a good week and almost recouped its year-to-date loss.
Yeah.
And precious metals we've discussed, but gold had a very good week, as Keith said, up nearly 5%, 11% year-to-date.
Congratulations, Richard.
Thank you, Keith. Thank you. It's been a long time coming, really. And okay, a car in 1920 would have cost you 1 kilogram of gold, and a rather fancy car, I have to say, in 2019 would also have cost you 1 kilogram of gold. So there we are. It's the same with the suit, isn't it? I think it's 1 ounce of gold would have bought you a good suit in 1900. It'll buy you a good suit, roughly speaking. Now, Chinese gold imports have surged. It's because they don't want to be holding too many US treasuries. But actually, if you want to replace $1 trillion of US treasuries with gold, you've got to buy a lot of the stuff.
Yeah, you do.
Really have.
Yeah.
It's what is it? It's 30,000. It's $30 million a ton. So if you want to put $1 billion into gold, you have to buy 30 tons. If you want to put $1 trillion in, you have to buy 30,000 tons.
Yeah, but you can't, because that'd send the gold price through the roof.
So, exactly. So how do you do it?
Yeah.
Maybe. Yeah. I mean, you could send the gold price through the roof, particularly if you've got a lot of it.
Yeah. Yeah.
And then
message to the Chinese: please buy a lot of gold. Richard needs you.
And then you have to buy less of it because the price is higher. So in some senses, it's
well, exactly. Yeah. Well, so this is, we were talking about the stock market and how do you increase net asset allocations to equities. You do it by driving the price up.
Yeah.
The same with gold.
So can I just point out, it's not me who's driving the price up?
No, you're too modest, mate.
So annual dollar returns from holding gold from date of purchase to the present. So I do know if you bought it in 2000, actually your annual return would have been about 7%. This chart is saying.
Yeah.
It's 9%, but
9%. Yeah. So thank you to our Discord member Simon W for sending us this chart. Very interesting. Basically, a lot depends on when you buy it and bought it, but the actual average return is really impressive.
But you do have to hold it. You can't buy it for a little bit and then flog it.
Yeah. So reminder, my daughter's SIP is entirely in gold. She's doing all right, much better than her dear old pa.
She's got how long till she retires, Keith?
40 years. 46 years. So, by that stage, gold will be,
She'll retire able to keep you in the manner you want to be kept.
Well, as long as she doesn't need any gold teeth, Richard, or whatever.
Yeah. So silver had a better week than gold, but is about year to date the same.
Yeah.
Platinum didn't really see up 3.3. But the platinum group metals haven't really reflected the price rise in gold, I think, have they yet? Although they may do. No, it hasn't really fed through yet.
Rhodium.
Palladium, likewise.
Thank you, Richard. Finally, on to rates. And it's been a bit bloody rubbish, frankly. So UK rates have risen over the last month, despite the fact that inflation in the UK continues to undershoot and the UK economy is going absolutely nowhere. And that's because US rates have risen, and the US 10-year yield chart, which is showing in a sec, is not very encouraging. The market thinks that the US economy is strong and the Fed will be slow to cut rates. Now, the current yield curve inversion is just about the longest ever. And reminder, that is the best predictor of a recession. And so far, it's been dead wrong. And this is my problem. The market is forecasting that equilibrium interest rates are much higher than pre-pandemic. And so now equilibrium interest rates in the UK are going to settle about 3.5%. And when you look at historically, it is true that the post-GFC era is really anomalous. And actually, if we've gone back to normal, then actually that may be true. Now, in my big gilts trade, have been assuming that we will go back to something like pre-pandemic. And if that's wrong, then I've messed this up and lost a lot of money. But we shall see. I still think that interest rates are going to come down. And, we look at the trouble with doing these analysis is that we miss out asset prices. And if you look at house prices in the UK, they have gone through the roof, and they're not sustainable when you have mortgage rates at 5%, because a house in my area, a terraced Victorian house, is about 1.4 million. I mean, nobody can afford that. So I think interest rates are going to have to come down. In the case of the US, a similar picture. Although you notice actually how low US interest rates were post 2000.
Yeah.
And this are EU interest rates, similar story. So unless house prices collapse, then I think interest rates are going to need to come down. And also we need a lot of investment. But the flip side of that is that, we've talked about increased productivity. Long-term interest rates are a function of productivity and what return you can get on your money. And if productivity is increased, then that means the return on investment has increased, which means demand for savings has increased, which means long-term interest rates will also rise. Now, this is forecast interest rates in 5 years' time, and they're very high, basically. So markets are optimistic that the economies can live with these high interest rates. And so far, that's been absolutely true. And this is the corporate bond spread, which is, an all-time low pretty much. So the markets are not remotely concerned about rising defaults, the possibility of rising default rate. And normally, when the Fed hiking cycle ends, bonds tend to do well. This time, it's not happened, and that has really caught me out. So I was expecting peak in rates to lead to falling interest rate expectations and cuts, and bonds to do well. That's not happened, and I am getting stuffed. Now, on your point, Richard, about, QE coming back, last week, the Fed did a little experiment. So it bought back $200 million worth of long-dated bonds just to see if it could work. But they're talking about a regular buyback program later in the year. That is yield curve control.
Isn't it just?
So watch this space. Okay, so this is the UK 2-year going nowhere, despite, inflation expectations. Sorry, despite UK inflation coming down. 10-year going nowhere. 30-year going nowhere. I need it to come down. US 10-year, this is a really ugly looking chart. That looks like it's trending back up. In contrast, the EU appears to have got inflation under control. We are approaching June, and the EU looks on track to start cutting rates in June. So European bond yields appear to have peaked. Italian, Greek. Concluding comments. Well, events in the Middle East are increasingly affecting markets, with both oil and gold rising. And that in turn has led to equities falling back from their recent highs, although futures are picking up this morning after the late sell-off in the US last night. Volatility is rising again. China Chinese manufacturing PMIs rose, leading to a good week for industrial metals, and bonds have been struggling. Richard, you must be doing well.
Well, it has been a good few weeks for me, Keith, because obviously over the last year or so, the price of uranium has been generally trending upwards, although it hasn't. It's come off a little bit recently. Copper has gone up, and precious metals have gone up, which are my main holdings. I have been waiting a long time for it, and the precious metals shares have responded well on this occasion to the rise in the price of gold and silver. So that's been good. I mean, it's been a very sharp increase, and I think there's been a squeeze actually, which has caused it. Like a lot of people were expecting the prices to drop, and there's been a short squeeze. I also think there's probably a shortage of physical gold and quite possibly silver because of the amount that's being drawn off by central banks particularly, and also possibly wealthy investors who want to park their money somewhere other than US treasuries. And so I think that it's sustainable, and I'm just sitting on my hands, and I'm going to carry on doing that for quite some time. And I haven't made any change to my portfolio. So,
yeah. Thank you, Richard. It was shit. So it's like I'm doing very badly at the moment. I've got this totally wrong so far, in that, we've been talking about this endlessly, but we'll be expecting inflation to come down, leading to falling interest rates, good for bonds. And the resurgence in the US economy has led to rising interest rate expectations there, which, despite the fact the UK economy is not doing well, has led to rising inflation interest expectations in the UK. So I'm doing really badly, both in absolute terms and relative to the all share. But I hope and I expect the US economy will slow in the coming months because of the reasons we've covered extensively this episode. The fiscal impulse is negative, the credit impulse is negative, construction impulse seems to be falling over. So I think the market's got a bit of ahead of itself, and I hope to get out of this trade better than I am now. And my cyclical approach has not worked, but you live by the sword, you die by the sword, and medium term I do all right, but at some stage got to make hard decisions, and we will see. But inflation coming down, UK economy is stagnant. It needs to cut interest rates at some stage, and as long as inflation keeps on falling, the Bank of England should be in a position to start cutting interest rates later in the year. And then I would hope that this trade starts to improve. Right now it's terrible, and broken record on this, but anyway.
Well, sometimes you have to stick in there, Keith, don't you?
Yeah. So, but if gold's doing well, you expect, again, like all the correlations are broken down. Normally gold does well when interest rates are falling, and gold's doing great. So I've kind of chosen the worst possible bloody asset for very good reasons. Now, reminder, next week we are away. I'm in Boston to run the marathon, which may be my last marathon, so this aging carcass can then retire. And I hope you're all doing better than I am. But anyway, so thank you all for watching. Please, can you press like and subscribe to the channel? And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only, and should not be relied upon for making a business, legal, or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, We make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.